lecture is about the income statement, which you may recall has many aliases. It is sometimes called the statement of operations, the profit and loss, receipts and disbursements, revenues and expenses. There's a number of terms that are used for essentially the same thing, which is a calculation comparing the revenue, which is what you've charged your customers, with the expenses you've incurred in order to make the money you've charged to your customers. So it is a measure of profitability. It is by far the most popular statement because most people care more about whether they're making money than they do about what's on their balance sheet or cash flow statement, certainly until they take the course, and then hopefully they'll change their mind about that. So we do these monthly, quarterly, annually. I don't know if anyone is doing a profit and loss every single day. In some systems you could. What you're trying to look for here is to make sure that you have the same time period of revenue as you have for expenses. So you've got March revenue. You don't want to have any April expenses or any February expenses included in this monthly calculation because it's more valuable to you to know exactly what you made in the month, not some combination of other expenses. So your cutoff, which is a term that we use quite a bit, is important. Have you made sure that you cut off March activity? You're just looking at March. You're not including some stuff that happened in April. And we'll talk about that in other lectures as well. And of course, your income statement is only as good as the information that you that goes into it. So if you're missing any transactions, any expenses that are out there, people haven't submitted their expense report, then your income statement isn't accurate because those information is just not included. So in this example, we've got revenue followed by expenses for a calculation of net income before tax, then the taxes, then a net income after tax, which, as I said in an earlier lecture, is called the bottom line. With that information, we can calculate the retained earnings, which I mentioned in the last lecture, has to go on your balance sheet. So the concept of retained earnings is the amount of profit that's been retained in the business since it was born. So your retained earnings go up when you make more than you take out as a dividend, and they go down when you take out more dividends than the money you make. So this calculation illustrates that. We have a retained earnings at the beginning of the last year of $16,000. By the end of last year, that was down to 8 because they took $28,000 out and they only made 20. In the column we have as this year, they made $30,000 and only took 28 out as a dividend, so the retained earnings went up by $2,000. That calculation, of course, is important to maintaining the equity in your business. You can't continue to take more out than you make. So this statement, starting at the top, has revenue. You will have the categories of revenue that are important to you. You'd only have to have one number pretty much to file tax returns, but you would like to have your revenue broken down in a way that's helpful for you to understand your business. So if you've got main categories of revenue such as residential and commercial, or you divide it up by geography, then you want your income statement to have those categories so you can quickly look and see, geez, our residential work's down, but commercial's up. You get that information just by glancing at it, whereas if you only had one revenue number, you wouldn't have that information. The expenses, again, will follow the categories that are important to you. I have these in order of magnitude because many of my clients get bored pretty quick looking at this page, so I want to talk about the most important stuff before they turn the page. So you've got wages first, followed by rent, depreciation, office. Again, these are your categories. It has to fit on this page. Most income statements, when they're presented officially, have to be on one page. Your internal ones, of course, remember they don't have to follow all the rules. They can be as long as you like. So you have the categories that are important to you in order to understand your business the best way possible. So make up the categories you want, make sure they're on your financial statements, and then you can compare them year to year, month to month, quarter to quarter, and you get the information you need. So this lecture was about the income statement, which is a statement that shows you whether or not you're making money. The revenue is what you charge your customers, the expenses and what it costs you to do that. You try to do it as accurately as possible each month so that you can manage your business the best way.